Hello, good afternoon everyone. I would like to welcome everyone on to today's event on incentivizing, aligning and retaining key employees. It's great to host everyone today. If anyone has got any technical issues throughout the event, please do feel free to contact us using the chat function. If you've got any questions throughout the event, feel free to put your questions in the Q&A box and we'll pick these questions up and do our best to answer these in the Q&A session at the end of the event. So my name is Carl Taylor, and also on the panel this afternoon we've got Gerry Surtees, who's a chartered tax advisor here at Oldfield. Good afternoon, Gerry.
Good afternoon all.
So in today's event we're going to be covering off on three of the most powerful ways to incentivize and retain employees. That's the first three key points on the agenda there. So we're going to run through these three powerful ways to incentivize and retain employees. Then we're going to wrap up with key takeaways and next steps and Q&A session right at the end. We want it to be interactive. We want you to ask questions as they come into your mind and put them in the Q&A box, and we'll do everything we can to answer those at the end of the session. So as we said, today's event is all about incentivizing and aligning and retaining your key employees. We all know that as a business grows, you can't do it on your own. A sustainable and healthy and profitable growing business really relies on having a team, a focused team, all driving in the same direction with a common goal, sharing responsibility for key decisions and passionate about the results. So before we sort of dive into the three ways to incentivize and retain employees, we really want to just stop for a minute and just ask ourselves, why is incentivizing and retaining key employees important? Why is it such an important subject? Why should we be focusing on it right now this afternoon? Well, first of all, it's really about the cost of losing key employees. If you think about the cost involved in a key employee leaving, it's not only the cost of recruitment for a replacement, which can be significant in itself, and the training of a new person. It's all the other intangible aspects that have a real impact as well. So things like the opportunity cost of missed or lost sales because of a key person leaving, extra time and input and distraction for the directors because of a key person leaving, the extra stress and the extra time input that's required, extra pull on a director because a key employee is gone. There's then the risk of making a bad decision on a new hire. So there's always that risk when recruiting someone new, and especially so the key role. There's loss of IP to the competition. So there's the potential with a key employee leaving that some of the key knowledge, some of the key IP, intellectual property of the business ends up in the hands of competition. There's the damage to employee morale if a key employee leaves. So that's quite intangible, but the actual impact of that's quite intangible, but definitely very real. Could be significant. If a key employee leaves, other staff members, impacting other staff members' morale. And then impact on customer service, loyalty. May lose key customers, significant customers, because they've had a good relationship with a key employee. So as we said, the cost of some of these points is really quite intangible and really hard to define, but nonetheless very significant. Really hard to actually put a number to. But there are some statistics out there that say for a sort of senior or key employee, the cost of recruitment and training of a replacement can be between 1 to 2 times their annual salary. And if you take into account all of these significant additional factors that we've just talked about, the overall cost of losing a key employee is significantly more than that. On the other hand, there's the value of an effective scheme to incentivize and align your team, to align your key staff members. And that the value of that, again, is quite hard to put a number to, but is also very significant. Incentivized and aligned key employees, they give the extra degree, they go the extra mile to make things happen. And as a result, they've got much higher productivity, helps to lift the productivity of the whole business, and that helps the whole business to achieve growth quicker, and that helps to increase the value of the business quicker. Means that key employees are taking more responsibility, which means there's less dependence on the owners, and key employees are retained. They're not just about to leave and disappear off. So again, very hard to quantify the positive financial impact here of all of these, quite intangible, but also very, very significant. I think we've seen that in reality. We've seen the real positive impact that having a good incentive scheme in place can really have. There were just a couple of examples that we've had over the last few weeks, months, where an effective incentive scheme for key employees has been essential and successful. We had a sort of growing business the other day with a sole direct shareholder who was really taking most of the key decisions, taking most of the responsibility for driving growth. But they also had some very key employees that were also bringing in a significant proportion of the business. And it was really quite a risky situation. Any one of those key employees could have left at any moment, set up on their own, and really damaged the business. So it was really critical to put an incentive scheme in place to retain and incentivize those key employees, make them stay. So, if you're a sole director shareholder that's really making most of the key decisions and taking all of the responsibility of getting the right incentives in place for key employees, really just allows you to spread responsibility, give others a real sense of ownership to help drive things forward and reduce the dependence on you. And there was just another example we had the other day where the controlling shareholders were really looking to pull back, and they were really wanting to exit in the next few years, and they were really looking to build a management team to take things forward as they headed towards an exit. So it was really important for them to set up an incentive scheme to align the key employees with that plan and give them a stake in the end result. And this had a very tangible effect of preventing a key employee from leaving, who was on the verge of leaving. They may well have done so if we hadn't put in a decent incentive scheme. So if you're looking towards an exit in the coming years, you'll be wanting to maximize the value of your business, and getting the right incentive scheme in place for key employees, it really helps to align them with your goal of growing the value of the business. And it will really help to retain them to make sure they stay the course until sale and help you to achieve a really decent sale value. So we're now going to unpack the 3 most powerful methods we've seen to incentivize and retain your key employees. Probably really important to say that these aren't the only methods, but these are 3 really powerful ways to do it that we've seen are really effective. And in some ways you could kind of combine them all at the same time in some ways. But Gerry's going to unpack the first one here on information, responsibility and autonomy.
Thanks, Carl. And I'm conscious this subject might sound a little bit fluffy, but what we would say is it's an essential starting point in retaining and incentivizing key employees. And fundamentally, no one likes to be in the dark, but for your key people, it's even more important that they're not only aware of the company's goals and plans, but also they're involved in creating them, take responsibility for them, and they have the autonomy and scope to deliver on them. And the thing not to underestimate is that this in itself is a powerful incentive. And fundamentally, you're much more likely to stick around to deliver a plan that you're involved in creating, especially when your input is integral to delivering on that plan. It's also, I think, important to say that it's crucial that this is in place before you start trying other methods of incentive, what you might call more traditional kind of carrot and stick type incentive schemes, which have their place. They're important as well. But the challenge is that if you don't get this bit right first, it's highly likely that other methods will be unsuccessful. So you have to take key people into your confidence. you have to entrust them with all information, financial and non-financial, that you'd want them to see. If you were in their shoes, you'd want to be able to see that information, and then you've got to trust them to deliver. And that's kind of the hard bit in a way. You've got to be prepared to take a hands-off approach, not only when things are going well, but also when they're not going well. And we all know that when things get off track, it's tempting to kind of dive back in again and try and get things back on the rails again. But the challenge is that if your team don't know how to recover themselves from a difficult situation, low performance, or something that's gone wrong with a customer, all those kind of things that do go wrong in business from time to time, you'll never be able to trust them to run the company in your absence. And let's face it, there's nothing that kills morale in good people more than a boss who keeps interfering with their area of responsibility. The final point is that it's important to agree a number that's a key measure of success or failure, and we like EBITDA. If you've got a number to manage, it brings that alignment, that clarity, and also accountability as well, in a way that other more subjective measures will never do quite the same. So we advocate EBITDA because it's a clear, measurable number, and it aligns the team, we think, around the most important measure, which is delivering growth in company value. Ultimately, that's what we're trying to achieve, or should be trying to achieve if we're in business. And ultimately, to get sustainable EBITDA growth, you have to get everything right. You've got your sales, your profit margins, your customer service, procurement, innovation, employee engagement. All of those things you have to get right. Ultimately, EBITDA is the best predictor of value creation that we know of. So that, I think, leads us neatly into the second powerful way to incentivize and retain employees, which Carl's going to talk to us about now.
Thanks, Gerry. So the second strategy is an EBITDA or net profit-based bonus scheme. Once you've shared the key financial information with key employees, then you've got a great opportunity to incentivize them based on the financial metrics that you really care about. And as Gerry has mentioned, for a lot of businesses, that's the EBITDA figure, because that's really what drives business value. And you've got to have a really well-rounded approach to drive and grow EBITDA. You've got to pull everything together to get it right. You've got to including things like pricing, maximizing gross profit, sales growth, profitability, customer service, developing, protecting IP, developing USPs. In simple terms, an EBITDA-based bonus scheme, it's really about setting an annual bonus scheme where key employees get a bonus based on the EBITDA result, and it might scale up significantly as the EBITDA result goes over target. So there's a real incentive to hit the EBITDA goal and exceed it. And that really can help us align and incentivize and retain your key employees. It brings in alignment, because it means your key employees are really thinking about EBITDA, and they're really thinking about how to maximize this. So they're really aiming for the same thing that you as a business owner are trying to aim for, which is to grow EBITDA and grow business value. And in practice, we've seen it really change the mindset of key employees. They're really focusing on, suddenly, their perspective changes, and they're actually focused on winning the most profitable business, focused on the real sort of sweet spot that the business fits in, and doing everything possible to retain profitable customers, and passionate about getting pricing right to maximize profitability, and managing costs effectively to really drive up the EBITDA. And it brings an incentive. It means the key employees are really trying to drive EBITDA up. They're trying to hit the EBITDA target. They're trying to exceed it so that they get their bonus. So it really means that key employees will be taking more responsibility to make decisions that will help grow EBITDA, and they've got a personal reason to really drive it. And then retention to some degree. If you design the EBITDA bonus scheme right, then the employees will have to stay for some time to get their bonus. That said, it kind of does tend to be a bit of a shorter term retention method, as it tends to sort of revolve around the financial year end and the financial year end results. So Gerry's going to talk to us now about the third point, and this really involves the longer term retention strategies.
Thanks, Carl. And I think what we're really trying to say here is that ultimately you need your employees to be focused on long-term value creation. And we tend to unwittingly kind of condition employees to think short-term with monthly pay packets and quarterly or annual bonus schemes. And as a result, what we tend to find is that long-term thinking is not something that comes naturally to employees. And ultimately, long-term value growth and retention go hand in hand. And by far the most powerful way to safeguard this with your key people is to have a long-term incentive plan, or what we would call an employee share plan. Put simply, what this is a plan that gives your key people a stake in the long-term value growth of the company. So this is done by giving them an opportunity to acquire shares or share options in your company. And the value of that will obviously hopefully increase over time and is realized either on the on-company sale or on some other exit event. And that, however, is conditional on them sticking around until that happens. So just to explain what we're talking about, there were kind of 3 points just briefly I wanted to touch on. Firstly, how we set up an effective scheme. Secondly, why would we do it? Why is this the best way to incentivize and retain those key employees? And thirdly, what you need to think about when you're considering an employee share plan in the implementation or even pre-implementation phase. So in practice, as we said, how does an employee share plan work? Well, it's about giving your key employees the opportunity to acquire shares or share options. And broadly speaking, they come to the same thing in terms of long-term value for the employee. And to be clear, what we're talking about, so we're kind of moving from the left-hand side on this slide where you own 100% of the company, the controlling shareholders own 100% of the company, to the right-hand side where you've got key employees who own, a small slice of the future growth in value of the company. And to be clear, this is normally only a share of future growth. In other words, current value stays in the hands of the current shareholders. So even so, and I can understand this feeling that some controlling shareholders can see this as a negative thing because it feels like they're giving away some value. But in practice, what we're finding is, as talking to business owners, that we're starting to see this as the best way of not only retaining, but also growing value as well. And the concept is that in the end, everyone ends up with a slightly smaller slice of a much bigger pie, to use an analogy. As always, there's lots of different ways of doing this, lots of different ways to structure it. And it's key this is done right so as to effectively incentivize. What we mean by that is that lots of schemes for employees involve just giving employees shares or options. But if they have to work to acquire those, that drives growth and engagement, both in the short term and the longer term as well. So as the slide shows, potentially a better way of doing this is what we would call a staged equity plan, which basically allows employees to increase their equity stake over, say, a 5-year period. If the company's EBITDA growth goals are achieved, then they get that extra tranche of shares vests, and they acquire those. And this is a really powerful way, we think, of driving employee engagement and growth, both in the short term as well as in the long term. Moving to the why, there's a number of advantages of an employee share plan over other forms of incentivization for key employees. First one is a sense of ownership. The part of the ownership, they're responsible for this thing. They're responsible to help drive the growth and the value. The second one, as Carl's already touched on, is alignment. Ultimately, they're wanting to achieve the same thing that you are. It's in their best interest to do so. So they're going to be aligned on the same journey as you. The third thing is really that it's a win-win for you and for them. And by definition, if there's a sizable reward for them at the end of this, by definition, the reward will be even bigger for you. And there's a bit of a chart here just to try and explain what we mean by that. And on the left-hand side, you've got what you might call an average growth curve for a business that hasn't got an employee share plan. And on the right, you've got an effective employee share plan in place, aligned and incentivized key employees. And the idea is that you should be able to achieve faster growth. And at the end of it, the employees have got a chunk of value out of it, but you as the controlling shareholders have got even more. So that's the objective behind all of this. Of course, we can't predict the future. We can't guarantee any outcomes, but we can say that we've seen this happen in practice. The next thing is tax efficiencies. So if a scheme is structured correctly, it can be very tax efficient, both for the employee and for the employer. So that's worth being aware of. The government want to encourage these type of schemes. They see them as a good thing. So there's a number of tax incentives that are quite attractive. And finally, retention. Ultimately, these schemes are always conditional on the employee staying to an exit. So what that means is that if they decide to leave and go and work for the competition or do something else, they have to hand their shares back, and they don't get the upside. Finally, just to cover some brief points on some practical points really for you to think about when or even before implementing an employee share plan. There's a lot of detail that can be gone through on this, much more than we can cover in a brief session, but just some key points to think about. Communication is absolutely number one. And the reason for that is because if you don't get your communications right with your key people, the why you're doing this, the objectives, what you're looking for, what's in it for them, and so on, ultimately people can't be incentivized by something that they don't thoroughly understand. So what you end up with is something that potentially could be ineffective and just a waste of time and money. So the communication is absolutely number one. Kind of coming out of that is the information sharing as well. So it's really important that you're sharing the right level of information with those key employees. You're open with your numbers, both up front and ongoing, keeping your people aligned with those objectives. And ultimately, that's something that you have to do. And obviously, as advisors, we can help you with that, provide you with the framework and so on. But it's not something that the scheme will do for you in that sense. You have to keep that kind of line of communication going, so people have got line of sight to the objective. The other thing is there is a balance. It's important not to overcommit too early in the process. It's a bit of a fine line to tread, but you're better to err on the cautious side, as if you've promised something or seem to have promised something, it's very difficult to go back on it. So just be careful. And then the final point that we want to just mention was training. As we said, employees are conditioned to think short term, and you'll have to teach them to think longer term. Remember, it's a new journey for them. They've not done this before, and they might even need help with learning how to interpret and read a set of accounts or understand how EBITDA drives business value. Be prepared to invest time to give them a clear line of sight between their day-to-day, what they're doing every day in the business, and how that influences the final objective, including obviously what they're going to get out of it at the end as well. So they were just some key points I've picked out. There's more to cover, which we don't have time to go into today, but we will provide a link after this event to a more comprehensive white paper, which you might find useful to download and have a look at. So back to you, Carl, if that's all right.
Thanks for that, Gerry. So in terms of next steps, before we open the floor to questions, I just wanted to mention that we are sort of giving the opportunity for you to have a follow-up conversation with either of us. If you're looking for more information on what we've talked about, you're not sure about the best way to incentivize key staff members, if you're still trying to understand how an employee share plan actually works, you're debating whether an employee share plan is for you and considering what to do next, the best thing to do is get in touch for a conversation with us. Look out for a link on the follow-up email and a link along with the link to the white paper that Gerry's mentioned on the key points to think about when and before implementing an employee share plan. So we're just opening up that opportunity for you to have a conversation with us if you're not sure where to turn next on it. So we're now going to move on to Q&As. Just before that, I just wanted to mention that the next big event on the calendar is the autumn statement. Chancellor's making his autumn statement on November the 22nd, and we are running an event on the same day in the afternoon at 4 o'clock in the afternoon to give you some rapid insights into what's come up at the autumn statement, what you need to know as a business owner from the autumn statement. So I look forward to seeing you on that event. So now for the questions and answers. If you've got a question that you want to put to us, do feel free to put it in the Q&A box. I've got some questions here to run through. Let's have a look. So the first question I've got here is, can I gift shares to employees or do they have to pay for them? What do you say on that one, Gerry?
So I think the answer to the question is yes, you can. You can gift shares to employees, but there is a tax cost attached to that. In other words, anything that you give employees of value, including shares, is essentially taxable on them as employment income. So often what's preferable is to either issue the shares at market value, so they have to pay for them, or structure it more as a growth share type structure. The important point, I suppose, to make on that is that valuation in either case, actually, valuation is really important, because that's the basis on which you pay tax, or the basis on which you try and avoid paying tax in the case of growth shares. And it's the first thing that HMRC will go after if they're trying to undermine what you're trying to do. So it's really important to make sure that valuation piece is robust.
Thanks for that, Gerry. So some more questions coming through here. Question here: why is a share scheme better than a bonus scheme? I guess it's really about the longer term. An employee share plan is really about the longer term. It's about sort of bringing key employees on a longer term journey with you and incentivizing them to sort of think longer term and to really think about the value of the business and about trying to drive the value of the business forward, trying to increase the value of their stake that they've got in it, and in turn, obviously, that's increasing your stake in the business, or increasing the value of your stake in the business. It's really hard to do that with a bonus scheme. It's hard to have such a long-term incentive built into it, just a normal kind of bonus scheme. Bonus schemes just don't tend to be necessarily aligned with long-term value creation, although an EBITDA or net profit-based bonus scheme does go some way towards it. But an employee share scheme really does give a much longer-term incentive and it's a better opportunity to retain key employees, because obviously if the employee leaves, then they're kind of forfeiting the value in those shares. And a share scheme will give a more tax efficient outcome for an employee and employer if it's set up right. Another question here is EMI better than growth shares? Gerry, you've got some comments on that one.
Yeah, sure. And we see both in practice. Just to explain, EMI stands for Enterprise Management Incentives, and that is a what you might call a government-backed scheme. So it's something that the government have set up and promote in order to promote employee equity ownership. Fundamentally, it's a share option scheme. So employers give employees the opportunity to acquire share options, which they can then exercise to acquire shares, and usually at the point of exit realize the value in those shares. Ultimately, EMI is the most tax efficient route, so that's always the thing we'd look at first, because it is so tax efficient for the employees. They only pay 10% tax when they sell the shares, and there's also benefits for the employing company as well. However, it doesn't fit in all situations, and in particular, your type of company or the industry you operate in. There's certain company types and industries that the EMI specifically excludes. So it doesn't necessarily fit in those situations. If it's not a fit, the next best alternative, if you like, we tend to go for is growth shares. So that will often be the best alternative where EMI doesn't work.
Thanks for that, Gerry. Just got another question here. What happens if an employee leaves? Which is it's a good question. The point really, or the whole point of an employee share plan is about retention. It's about giving key employees a real reason to stay, and so it should be less likely to happen that a key employee leaves. But obviously, there's always unforeseen circumstances that come up. There's always things that are unexpected that crop up, and there might be a situation where a key employee that's on an employee share plan does want or need to leave. And if they do, generally there'll be leaver provisions written into the agreements, which mean if they do leave, then they just get back what they paid for the shares in the first place. So that does just sort of reduce the risk for employers putting employees on an employee share plan, because it means that if an employee does leave, well, you haven't got to pay them out the full value of those shares. At that point, you just pay them back what they paid in the first place for those shares, and move on. Obviously, that does then mean that it is a real incentive for a key employee to kind of stay the course and stick with it, stay with the business, drive the value up, so that when an exit event does happen, say if the business was sold or something like that, they can actually realise the real value that's in those shares at that point. Don't know if you've got anything to add to that, Gerry.
Yeah, I think that's good what you've outlined. I think the only other thing I would kind of add to that is that, as you've been saying in relation to the leaver provisions, the critical and crucial thing about that is that you've got the right legal agreements in place, and that's really important in all of this. Proper implementation and proper robust legal documentation, and the right professionals to help you with both the legal and tax aspects of it is really crucial, because the implications, if you get it wrong, can be very significant, both from a tax point of view, but also from the point of view of, what then happens if your documentation isn't up to scratch and an employee leaves and you're suddenly faced with a big payout. That would be a very unfortunate situation to find yourself in. So I think really just a plug for that, really, that it's worth getting the right professionals involved.
Good, thanks for that, Gerry. Good, well, we'd like to thank everyone very much for joining us on today's event, and look forward to speaking to you soon. Thank you.